Thanks so much for tuning in. We're continuing with our post-budget analysis, and of course, the equity markets have turned for the worse as well. Other factors may be beyond the budget, but let's put all of this into perspective with, a very large asset manager out of India. Prashant Khemka joins in. Prashant, great having you. Thanks for joining in and taking the time out on such an important day.
My pleasure, Neeraj. Thanks for having me here on the show.
So, Prashant, a quick, before we get to the integrities of the budget, the nervousness in the markets currently got to do with some fine print in the budget, you think, or is it beyond the budget factors that might be doing this?
I think, as you can see, the market's been very choppy because there are a few undercurrents in the market that have been at play. But I think the budget per se is a very positive budget. And I think it's having a positive influence on the market today. Even if the market's down, you can think of it this way, that market might have been down even more if you take out the positive related to the budget.
Got it. What stood out in the budget for you, Prashant? I mean, they've stuck to the fisc glide path, but which was maybe largely anticipated. If it not been the case, it might have been a problem. So what has stood out in this budget for you?
So first and foremost, Neeraj, we have to remember it is a pre-election budget, pretty much, right? The 24 budget would be more of a nominal budget, if you will. It is really the pre-election year budget. In that context, when you think of it as being a pro-sustainable growth budget, so not just pro-growth budget, I would say pro-sustainable growth budget, in that it wasn't as heavily focused on consumption, subsidy-induced consumption-related growth, but rather capital outlay, capital expenditure-driven, more infrastructure-driven, which is more longer-term sustainable growth. So if I were to highlight two factors which are both positive for structural sustainable growth in this budget, one, as I was just saying, the capital outlay on infrastructure. Secondly, also there are numerous elements, while maybe not each one on their own, not as substantial, but taken together collectively, they do add up to a meaningful level of positive progress towards ease of doing business. And as I've said before, ease of doing business, the biggest problem, holding back India's growth. So this was positive development. If I were to highlight, few of them, it's obviously the fine print has to be seen, but the FM announced 39,000 compliances where it would be made easier to comply with these 39,000 compliances. That's a fairly material positive. If those 39,000 compliances, when you look at the fine print, the burden of those have been materially reduced. There are more than 3,400 legal provisions that have been decriminalized. One of the big hurdles, one of the big anxieties for businessmen in doing business in India is there are so many laws that have criminal consequences, violation of even smaller laws, which oftentimes could be accidental violations. If they have criminal consequences, that's a big hindrance to promoting ease of doing business. So 3,400 of those legal provisions to be decriminalized. Nobody's talking about them because these are not quantifiable necessarily, as fiscal deficit is quantifiable and capital outlay is quantifiable. But these are very important steps forward besides other initiatives that are pro ease of doing business.
Prashant, for the longest time for equity markets, it's been a consumption-oriented budget or no. The last two budgets, we've had a capex kickstart of sorts. This time around, it seemed interesting that they are veering towards populism by spend on infrastructure as opposed to populism by freebies, or the freebies are in the form of infrastructure dole out. What is the investing implication of something like this? Because it's now 3 budgets in a row, as I said, that we've seen remarkably stepped up capital expenditure focus from this government.
Certainly. So it is positive because consumption-oriented, subsidies-induced consumption-oriented growth is a one-off growth for a particular year. And you need to then make up for that next year again, and then the year after again. Whereas infrastructure, it is like, in any business or at our home as well. If you invest in, let's say, if I were to give you example of family, if you invest in education, that is capital expenditure that pays off for the rest of your life. Whereas if you spend on a vacation, yes, it feels very good that year, but the benefits don't necessarily last for that long. So investing in, from a country economic perspective, investing in infrastructure, for example, the increase in railway budget is 9x compared to 10 years ago. The figure that was announced was, just give me a second here, $30 billion, 2.4 lakh crores, which is a 9 jump from 10 years ago. Now, railways, India badly has been in need for improvement in its railway infrastructure. We've all heard about the Vande Express and the success of several other such initiatives. And it is something that, an infrastructure that would serve India for the next 100 years. So expenditure on such infrastructure is growth, is a boost to growth for decades to come, rather than the subsidy-induced consumption, which is for a year or two. The feel-good factor lasts for a very short period of time. And hence, this is a very positive, sustainable growth budget.
Got it. Prashant, now what the markets beyond? I mean, there's this whole drawdown that we're seeing today in the Adani Group stocks, and that's having, I believe, a fair degree of nervousness chatter in the markets. There is FOMC slated to come up later on in the day today. And of course, we then look forward to the RBI policy as well. So how do you look at what the equities and the bond markets do, keeping in mind all of these macro fundamental events and the high frequency events that the Indian markets have been now kind of dealing with for the past 7 or 8 days at least?
Certainly. As I said, there's never a dull moment.
Yeah, there isn't.
3 years ago, this time around, it was COVID that was hitting the headlines. A year ago, it was the Russia invasion of Ukraine that was just about to hit the headlines. And this year, there are several other headlines that you just pointed out. So it's always a confusing state of affair for investors and for fund. When I say investors, it's for fund managers as well. And a lot of these are unpredictables. You just have to see a day at a time. It's just like with COVID, it was unpredictable. At this time in 2020, it was completely unpredictable which way the pandemic would go. It's fortunate that the mortality rate was much lower, and it's fortunate that the vaccine got developed within a year. Now, with last year's Russia-Ukraine, it's still unpredictable which way it goes. Obviously, the degree of uncertainty was a lot higher last year, and it has become more of a going concern problem at this time, if you will, the Russia-Ukraine. But it can, at any time, erupt into something much severe, or tensions could ease as well. And some of the issues now this year at this time are at their peak because they're so recent. But it's very unpredictable how they evolve over the coming few weeks or months. But my expectation is that those issues, the heat around these issues should subside over the coming few days.
Okay. My final question, Prashant, you have experience of how global markets do by virtue of having run the Goldman portfolio on the global side for such a long time. Fair degree of experience around the EM side as well. Now that the budget event is out of the way, and because the budget has done no negative, and therefore let's construe that as a positive too, aside of the capex and the other related announcements, what would you believe, or where do you believe India stands in the pecking order vis-a-vis some of the other emerging markets, and EMs versus the DM argument, considering that it's not that US markets are terribly expensive, let's say, compared to what they were about 12 months ago. So how do you look at this whole landscape from your vantage point?
Well, certainly, Neeraj. So we do right now, the team, including myself, do manage a global EM fund as well. And this is a very pertinent question that is posed by numerous clients, and they've been posing this over the last several months. So I think as of right now, where we stand today, and it has been the case over the last at least a month or a little more than a month, investors globally are somewhat more positively disposed towards emerging markets than developed markets. This is somewhat of a reversal after a pretty long time, where investors, after for several years, I would say, were more positive towards developed world. I would say pretty much since the onset of COVID, that was the case. But at this time, I find investors more positive towards EMs. Now, it could be purely a function of the fact that EMs have done, after a long while, EMs have done very well against developed market over the last 3 to 4 months, since China bottomed somewhere in October, November timeframe. And as China has rallied about 40%, close to 40% now from the bottoms, which has obviously, because of its large weight in EM, has had a positive rub-off on the overall EM index. So I think primarily because of the strong performance of China and that of EM, EM has outperformed developed world over the last 3 months, and that has led to an improved sentiment of investors towards EM where we stand today. In the same context, I would say India was the top preference within the EM context till, I would say, a couple months ago. And that's because India was an outperformer amongst the major markets. If you were to think, when I say major markets, China, South Korea, Taiwan, say Brazil, and so on, India was one of the main outperformers over the last couple of years. And when you are outperforming, you tend to be preferred. It's not the other way around. Many people think that because the sentiment is positive towards India, that's why Indian market's outperforming. It's the other way around. Because Indian market was outperforming, the sentiment towards India was positive. But if you look at year to date, India's, or even last 3 months, as China started outperforming, India obviously wasn't going down, but it was going nowhere. And so relative to EM, India has underperformed. So of late, there has been a move in the sentiment, global sentiment. So first, the move has been from developed world more towards EM. But within EM, India has somewhat fallen down the pecking order of preference. So this compares to, let's say, scenario where till 3 months ago, people preferred developed world than EM. But within EM, India was the top of the preference list. I hope that makes sense.
Well, it does. It makes immense sense, and it gives a perspective of how somebody looks at global picture by and large, and not just an India-focused view would think about this. So it really helps. So thank you for this. Thank you for giving us your budget view as well, Prashant, and some idea about how you're thinking about things currently. It really helps our viewers.
Thank you so much, Neeraj, and thank you to all your viewers as well.